My name is Jehan, and I'm the founding partner and managing director of Kenetic. Kenetic is a blockchain and cryptocurrency investment platform fund. We do high frequency trading and we do investments. We've been in this space since around 2016. I've been in this space for, just around late 2013. But with today's hat on, I'm the founder of the Ethereum Meetup. So if this is your first time, welcome. We've been active since March of 2014. So we're one of the earliest kind of Ethereum meetups in Asia, if not the first. Today I'm super excited to introduce an old friend. We definitely don't talk enough, but he's definitely, one of the earlier people in the space that I've kind of met and come across when back in his days at Consensys. He's honestly one of the people that that comes up in kind of casual inspirational crypto talk the most, primarily for his work in attention markets and curation markets, and more recently in bonding curves. I'm really happy to welcome Simon de la Rouviere. Simon's background he'll tell you about much better than I can, but I knew him from the early days of kind of Consensys, and kind of followed a lot of his writings along the way, and really his writings are really the kind of writings that started me off thinking about this idea of token as signal. And so just to set the stage before I hand it over to Simon. Actually, Simon, do you want to say hi for a second?
Yeah, sure. I mean, if you want to give some background, I can start, but otherwise, hi everyone. Thanks for being here. Great to chat with Jehan again.
Cool. So just to set the stage, and then I'll hand it over to Simon. There was I don't even know when it was. What was it, like 2016? When did you write that article on Doge?
Well, I think I've written a few, but I think some of the original stuff goes back to when Dogecoin launched, like end of 2013, beginning of 2014.
Okay,
yeah.
Perfect. So when I read it, it was probably a bit later. And as you know, Dogecoin is basically, I think it's the number 31 market cap cryptocurrency with something like 70 or $100 million market cap. And it was one of the earliest cryptocurrencies. And what makes it remarkable is its lack of functional remarkability. It's basically a fork of another coin, and it really has no utility, and it has no ambition to have any utility. It doesn't do anything. It doesn't, power anything. And unless someone else accepts it, you can't really use it. You can't really spend it on anything. But somehow it has, $72 million worth of value, and which is supported by, the number 32 kind of like most active market. So there's something there. And I think that this idea of tokens being signal and membership, and basically owning Dogecoin, its real function is that you get to show that you're a member of the Doge community, was one of the most revolutionary ideas in terms of how I started to open my mind about what tokens are and what tokens are for, and what tokens could be used for in the future. We usually think about tokens as like, okay, it's like gas, like Ethereum, or it's like store of value, like Bitcoin. But as we start to, that's really only scratching the surface. And I think that one of the most ripe and rich areas of kind of significance for tokens is this idea of token as signal. So that's pretty much what we're going to unpack today. And when I say we, I mean Simon. And so I'm going to hand it over to him. He's going to talk for a little bit. I'm going to ask some questions, and then towards the end, I'll unmute everybody and we can all ask questions. Cool? Great. So without further ado, Simon, please take it away.
Awesome. So I think just to first start off, for those who don't know me, I've always been a creator. In the past, I've made games, made music, made websites, made apps. I enjoy writing. I enjoy blockchain space. I enjoy art, just anything creative. And as part of that always has been like, I enjoy making things, but how do we make sure we get more people to also make things? And that's always been sort of a driving force about why I got interested in the blockchain space for back in, like, this is almost 10 years now, where I saw this technology that could empower creatives in various capacities, from the simplest level to simply paying someone in another country that doesn't have the same financial infrastructure. You know, growing up, when I made games in high school, I was like 15. I couldn't sell my games online as a teenager in South Africa. And when I saw Bitcoin, I was like, wow, like you can actually now do this, like without these like stringent requirements that might not even exist or are just difficult. So from there, it sort of catalyzed into various forms of seeing like, wow, we can empower creatives. And that eventually led me to thinking, and I think like Jehan said, one of the first key catalysts for me was seeing Dogecoin for the first time. Like I was interested in blockchain back then. It was only Bitcoin that was around as a tool for financial disintermediation. But then when I saw Dogecoin for the first time, I saw this power to create communities and empower communities in various capacities. And it didn't matter where you were in the world. You could be in Argentina or Hong Kong, South Africa, the US, wherever you could create value without asking anyone's permission. And that seems very powerful, especially also in terms of empowering creators. And that's where it sort of snowballed. Then I started thinking about tokenized communities. And back then in 2014, like none of the technology, it was very hard to use. And the only way you could really try this was to, you know, fork your own altcoin completely, like take Litecoin or Bitcoin, fork it, and do something with it. And that's what I did. I tried it. I made my own altcoin, and I was like, this is supposed to be like Dogecoin, but let's create a decentralized band. I was like, let's try to be as weird as possible and experiment, and also just learn. I was just learning as much as I can. And during that time, I was like, this is really difficult to do. And that's when Ethereum came around and said, we're going to make everything easier. And this was exactly what I wanted. And it all happened in very lucky ways, that I was at the right time at the right place. That at the beginning of 2015, you know, I got a call. I got in contact with Joe Lubin, who at that Consensys at that point only had one employee, Joe Lubin and another employee. And they were still stealth mode. And they found me online talking about all these crazy ideas. And they were like, do you want people to build this stuff? Like, and I was like, this is amazing. Someone's paying me to work on this stuff and invent a new future. And so from there, for 4 years, I worked at Consensys at the intersection of, exactly the intersection of like creative industries. So I was a co-founder of Ujo Music. We worked in the IP royalty space, automation of payments, intellectual property, to all kinds of token economics. You know, it's like, it seemed like these are different parts of the same problem, like making lives easier as it is and inventing new value. And yeah, so this is now at the beginning of 2019, I left Consensys. And since then, I've just been sort of taking a bit of a breather, working on unrelated like things to blockchain projects. Well, I still write a lot. I still think a lot about stuff. I still advise companies in this space. But I've primarily been writing, and I've been working on, I've only recently started coding again, just to see what things are like now. And that's where it is at the moment.
Awesome. Thanks for that. So let's just like jump right in. Let's assume that everybody here knows nothing about attention markets and curation markets and kind of bonding curves. Can you more articulately than I have explain the idea of tokens as a signal?
Tokens as a signal. So one of the key things that I saw in Dogecoin originally, as you said before, was that you had a new altcoin that didn't innovate in a technical capacity, and it had value. And to me, it meant that people were willing to undergo some kind of opportunity cost, which is take their dollars or euros, buy some other token, this Dogecoin, and hold it and spend it in this new virtual economy amongst a set of peers in this community. And what it signified to me was that this has value because it's a way to represent membership. And that's where I felt like, wow, this, if we could do this for like many more things, then this could empower so many people to form their own kind of communities in a new capacity. And that's where original idea came from. Like, could we build some kind of token economics where the economics itself lends itself to the token being primarily a token of a signaling token, because all forms of tokens have a signaling value attached to it. It's just not its primary component, right? So, you know, a part of Bitcoin's value is like, yes, you can transfer value, but some people hold it because of its ideological values. You know, I hold Bitcoin because it represents access to a community and my feeling about the way the world's supposed to work. Same with Ethereum. Like, you might say Ethereum is used as gas, but Ether as a token is also my personal desire to belong to a community that does innovative things in this space or chooses to build technology that empowers people. So every token we hold, and I would even say it's the same with other forms of value that you see elsewhere that is not blockchain currencies. Like people are like, I dislike America, or I dislike some currency, other country. I will choose not to hold that country's currency because of what it represents. And even things like shares, you know, like people can rock up in a meetup and say like, oh yeah, like I am here because I enjoy Apple products, so I have Apple shares. You know, it's a way to leverage your own belief in something. It's to say like, I belong, and here's my proof. I also invested in this capacity.
So let's kind of like go into that for a second, because why is, you know, the idea of this investment in this kind of membership important or different, right? Why is, like, if I own US dollars, I own Hong Kong dollars, why is that not Signal? Why is that different? Why is the tokenization of it specifically important?
Yeah, I think it's like it's merely because, like, in say fiat currencies, that signaling value is there. It's just very negligible or not part of its primary purpose, right? So in the case of Dogecoin, it was like, this was a very, like, if you could say, like, let's say like 90%, like 99% of most fiat currencies are as other primary purpose besides the signaling value. But in the case of Dogecoin, if you could have said it's like 80% of Dogecoin's value is a signaling value. 20% was maybe the fact that it had a blockchain that could transfer money very quickly and very low fees, you know? So there was some utility, but it wasn't its primary purpose. And today, so I would say like that idea is, I don't think we've entirely seen this proliferate to the extent that something like Dogecoin works or is working to millions of communities. Like, we haven't seen like millions of signaling currencies. It's only things like Dogecoin that still exists and or other crypto. And I think it still has to do with how the economics work, where you have to design it in such a capacity. That's a beautiful cat. Or you have to design it in such a capacity that like the signaling value is its primary purpose. And that's still difficult. And that's where like token bonding curves first came on, is to say like, let's find a way to boost the signaling value as part of the utility of the currency.
Okay, so before we get to bonding curve, so this idea that, you know, Doge is, you know, Signal as its primary value, but there are other coins, right? I mean, you know, people obviously are quite proud of holding Bitcoin and, you know, quite proud of holding Ethereum if they're, you know, or even, you know, Tron or whatever, right? So there is like, you know, a tribalism, there is like a factionalism and kind of identity component, which kind of comes along with tokens. Like, why is that? Like, why do you find that like protocols and tokens are so tribal, such that tokens become part of like your identity?
Yeah, I think it's a very good question. Like, it's like, why is there? Because I think the tribalism in the crypto space is a representation of the signaling value of currencies, and now we just made it possible for people to do this on a new kind of scale. And I think one of the reasons why that's the case, and I think it goes back, like, you know, into like prehistoric era, where as humans, we needed to figure out, how do we trust another person, and how do we trust another stranger, right? And one of the ways in which this is my current belief about where money came from is that if you obtained something that was difficult to obtain and you show that you had it, like a collectible, like seashells on the beach, right? Or cowrie shells, and you had it, it is a signal of the fact that you did something that was difficult to do and was worthwhile. And that then represented a signaling value, right? So it's like, how do I trust this person without there being any other way to trust them? Like, I don't even speak their language, right? So this sort of ability for things to be imbued with a sort of, the value only really became sort of a way for people to say something without using language, right? And it's literally say, I belong, or I want to belong, or look at me, I did something worthwhile, I want to belong.
Well,
so it's all about
that's super interesting, but it seems
reducing.
Like sorry, go ahead.
Another way to put it, it's about like reducing the transaction costs or the social transaction costs involved in communicating, right? If we all had something which we all agreed had like meaning or collectible value, then we can say we can work together without more costlier things like learning a language or speaking to a stranger and learning their language.
Yeah, there's two ideas in there that I think I kind of want to understand a bit better. One is that this idea of kind of belonging. So if you have a shell and I have a shell, somehow we belong together. Like there's something that ties us together. But then separately, in order for you to get that shell, you must have, dove underneath the ocean, and that means you have a certain, or at least it implies that you have a certain type of quality that obviously we both must share, because you have the shell and I have the shell, and there's only one way to get the shell. Is that kind of, where we are now with what signaling means in tokens?
Yeah, because like currently in like the space, it's like there are two ways to acquire a cryptocurrency. Like one is like by contributing to its security. So like you have a miner and then you mint new coins, right? Or it is due to some other value being used or exchanged for it, like an ICO or like exchange on a decentralized exchange or somewhere. I have something else in return for that. So all of these inputs is regarded as valuable. Like, so it's like, I have a miner which produces security. This input is valuable, thus it produces new coins, or I have some other form of currency or token that is valuable, and in exchange for that, I get this thing. And so there's this backing effort to this token in some capacity.
I think a more relevant recent example is kind of like any sort of DAO participation, like Meta Cartel. Like you got to do some sort of proof of work, but not like you got to make a meme or you got to do something, and then as a result you get some sort of club token that could only have been given to you if you made a good meme or you're part of a club.
Cool.
Yeah.
So
yeah,
I mean, I think that's interesting. So just to kind of progress this a little bit, because I realize that we're actually kind of chewing through time. Let's move on to like something more solid, right? So let's go to let's start talking about like attention, like how these things are actually applied, like attention markets, curation markets. Let's talk about that, and then kind of bonding curves and how they relate and are applied.
Mm-hmm. Yeah, I mean, currently, like a lot of the earlier ideas that I had were around the usage of these things for information curation.
Well, can you actually define what that is first? Like, I didn't really define that.
Yeah. So for me, it was a way to say like, there are different ways in which information is curated, right? And a part of it's either like altruistic needs and or individual needs, like either like people work together on a Wikipedia, or they have individual desire to read certain tweets and retweet certain information. But what I saw what could be possible is like to use some form of economic interaction in information curation that boosts signals or limits other signals. So limits negative signals, boosts positive signals, and it's up to the community to decide what that is. So a simple version of this is like, let's say you have a chat room and there's too many people in a chat room. If there's too many people in a chat room, then the value of the chat room goes down for everyone because you can't read the conversations. It's too much happening. And if there's too much conversation happening, then there might be a case where you start introducing some kind of economic cost, like to prevent spam, right? But that's one version. And the other version is to look at the ability for these kind of systems to also then create value for the specific community that is doing the curation. And that's where sort of the combination of like, okay, we can produce more novel signals by adding economic costs to communication, but at the same time, we can actually build value in this community. That's where the combination of using tokens for information curation started.
Now, you mentioned that that's kind of where your thinking was before. Has your thinking kind of changed? Have we seen examples of these kind of curation markets? I mean, obviously, I think was Steemit like one of these things, and is kind of what Reddit is doing now? Is that part of it as well?
Yeah, so Steemit was probably like the biggest well-known example of something like that, and still is, I think. Some people have tried, I think like District 0x's Meme Factory, Marble Cards have like a competition where like different memes or cards like compete against each other. But it hasn't been on a larger scale as I expected it would be. And I think my current belief is that it's due to various factors. One is that things are still early in general. Like I think a lot of these ideas will take time for people to understand them appropriately, and or just do the tough design work involved in making people understand what's going on. And the second thing is that when you do the work to do information curation, you kind of want to understand that what you're going to do is actually going to produce some form of value, like whether it's for yourself or for a community. And once you introduce economic value, right, which is measurable and quantifiable, it becomes sort of, you add like another extra layer of like mental computation to figure out, is this worth my time to get back 30 cents if I do this small thing? So it's like there might be like a limit, like a floor to what kind of things it would be useful for, what kind of information curation it would be useful for. So that's why something like Dogecoin exists, because its floor of value might just be like, what if it's $20 million of value being produced in this community? And anything below that, just no one will bother, you know? And that's still the outstanding question, like how granular can you go with the design of these kind of ideas? Because obviously after Dogecoin came out, a lot of people copied that principle. You know, you had all these meme coins started, like Penguin coin and like Kitty coin, and like, let's just do all kinds of things that simply represents the community. And most of it has disappeared. So it gives you kind of clues to say like, this big, massive infrastructure can't support a community based on that. But it's like, there's kind of correlations to what happened in the Web 2.0 space, where, you know, when you think about it, the idea of sending something like a like, you know, I like this photo on Instagram, right? That it was definitely possible before the internet, but no one did it when you think about it. Like no one sent a letter to someone across the world, and all it was simply a thumbs up. It's like, it's too costly, you know, it's like too costly to send that low bit of information, just literally, this is good, right? But once we lowered the barrier to entry to communication, that became feasible. So it might be that in the future, more of these ideas just become feasible because we're lowering the barrier or cost to do this. Yeah.
I love this idea of like postcard likes. I think someone on this call is gonna take that and pitch me for a startup. So cool.
Vintage likes.
Vintage likes, exactly. All right, so that's kind of the attention markets, curation markets. I mean, anything else you want to say about that? I mean, so it's going to take some time. People are going to need to kind of figure it out. But what about, you know, these, like, there's starting to be a proliferation, or at least there's starting to be some kind of presence of membership rewards tokens and a membership rewards token. So moving from kind of internal point systems for loyalty to actual tokenized kind of loyalty. Is that related to kind of like attention markets? I mean, it does signal membership, right? I mean, people, you don't even necessarily have to pay for a lot of these kind of loyalty points and cards. Where do you think that all kind of crosses over and goes?
I think it makes sense, because what you want is that the people that are involved with the community does specific actions that benefits the community. Like, you don't necessarily want like free riders to come along and doesn't contribute back into whatever your work you're doing together, like the shared goal. And so like the things where people do work for membership, it's just an easier way to like get like your initial community of people that you think is going to continue contributing to the specific cause. But it's not that money, if people give money in return for benefits, that doesn't mean it's bad. It's just like the incentive should be such that when people give money, it should be, I feel like it at least should be like a global benefit to the specific cause, rather than sort of an individual exchange. It's a bit vague, so maybe I can give an example of what that means.
One good example is kind of like if you give some like good in the commons, if you put a price on it, it ruins the altruistic value of it. So sometimes you're saying, oh, I'm going to do something for I'm going to be a Wikipedia contributor.
Yeah.
If I got paid 30 cents to do it, but I'm probably not going to do it, and it actually detracts more value than the altruistic.
Yeah, but that's also a good point about like why I think to some extent like some of these ideas specifically related to the curation of information is difficult, because you want to be careful to sort of cannibalize on other incentives and replace it purely with an economic incentive. We all sit on Twitter, we all add to Wikipedias and curate information online with no economic benefit. So there's other incentives why we do that. And if you replace it only with an economic benefit, then the users start serving the protocol rather than the protocol serving the users. And that's sometimes where you get this like janky bot economies that like bots upvote bots the whole time, and then it's only valuable to the people that play to the rules of this protocol. Yeah.
Interesting.
It makes me think of kind of like a stack exchange point. If you put a price on them, then the credibility of those points is useless. So
yeah, cool. We're going to save all the kind of questions for the end, but those are some interesting points. Thanks, Adrian. So I guess let's move on to bonding curves, because I think this is kind of in some ways where it all kind of heads home, right? What is a bonding curve?
So a bonding curve is based on my definition, and the thing is like the definitions change, and like some people have started using this.
Well, where does it even come from?
Yeah, I can describe where it came from. Where I got interested in this design space was to essentially create some kind of continuous token model where you could, like you said, do something useful, whether it's work or money, get a token in return, do something in the system. And if you don't want to be involved in the system anymore, you can get out, right? And like cash out, but it's all an automated system. And that's where bonding curves originally came from, was like thinking, okay, like I have some money, I want to do something. This gives me a new token to do something in this ecosystem or protocol. And if I don't want it anymore, I can get out. And so that's where the original design came from, but it was in this context of information curation. But since then, it's like took on a life of its own in new ways.
But who created this? Is this like some kind of ancient economic concept or what?
So before bonding curves existed, you had market makers as a principle. It's called scoring rules. So you saw things like in prediction markets, you had like kind of automated market makers existing. But bonding curves was primarily for the purpose of saying, I have one token of value, exchange it for a new token of value that represents something new. But in such a way that if more capital gets put into this new token, the cost should increase. And then if you want to leave, the costs go down again. But it was one of those inventions that was like serendipitous, in that it was like these kind of things happen at the same time from different angles. So the Bancor team also came up with the same designs, but they all use different kinds of language, you know, like reserve ratio, weights, connector weights, smart tokens, like it had different naming. And I came from a different angle. I wanted to create communities. They wanted to create exchanges. So that's where it came from. It was kind of invented at the same time by Bancor and myself. Yeah.
That's awesome. That's actually fascinating. For some reason, I thought that bonding curves was like, you know, some type of, you know, economic thing that was historically kind of pre-existing. But it's interesting that, and I remember when Bancor was pitching me back in the day, they were talking about this, and I kind of understood it, and I also kind of didn't understand it. But yeah, that was a long time ago, actually. That's great. Cool. And so let's kind of fast forward to today then. So how are bonding curves used? What are they used for? You know, and where do you kind of see them going? How are they being applied?
So originally, when I put some of the ideas down, and this is why I didn't personally get into designing products in the space, it's because like I saw that like at a broad use cases. So from the first articles, you can see like, let's do this for like a new kind of Reddit. Let's do this to curate issues. Like let's like make it so that people can mint personal tokens. Let's do it for like limited editions, stuff like that. So all these things in different capacity are now being tried by different people in the space. But what people have mostly done is take this idea to, I would only say like recently, perhaps in the last year, where I feel like it's more closer to what I originally had in mind, versus some of the other things in the interim that happened. So things like Fairmint, just like this continuous securities, like that is like, this is almost exactly what I wanted to see. Things like Zora and Foundation, which does this.
Well, actually, let's go into each of these, right? So what is Fairmint? What has it work?
So Fairmint has what Fairmint wants to do is give continuous fundraising to companies. You know, so basically you start from day one with an IPO, but the way company finance or equity usually works and is that, you know, if more investors want to buy something from, more investors want to buy equity, the price of the equity goes up automatically. So that's what you imagine it to be. Like new funds come in, new equity is minted, it's all automatic. And the way Fairmint does this is to basically separate the company into the organization itself, and then attached to it is like what they call, I think it's a trust or like a reserve on the side. And when you buy in as an investor, you buy into this reserve, and this reserve then siphons some of the money that's invested into the company itself, such that the organization can then use it as working capital. And part of this promise is that the company that has this extra reserve on the side promises to pay some revenue into this reserve, such that you as an investor can then get money back. So it's like two things on the side. Technically, it doesn't have to be separate, but I think legally, I think there are some reasons why they did this, makes it better legally. But essentially, as an investor, the benefits you have is you can invest in companies, they get working capital, but you always have some kind of liquidity if you want to maybe exit this investment. So Fairmint is a company that started the continuous securities system, but there was a team called the DXDAO recently that forked the Fairmint smart contract code and did this for a DAO. And I think they raised like several thousand Ether through this mechanism. And it's like, this is kind of perfect because like you just have like an automated system for people to invest and divest if they want to without requiring additional exchanges in the process. And that's been really great to see, and I'm quite happy. It's like this is what I wanted to see, and people are using this as a continuous fundraising mechanism.
One of the easiest kind of examples, and for me, like one of the most exciting examples of kind of a bonding curve in action is Saint Fame. And this whole idea of, the tagline is the internet's first fashion house, which I think is brilliant marketing. What is Saint Fame?
Yeah. So Saint Fame is the original version of this was the Unisocks, and then Saint Fame used the Unisocks idea, and then the Saint Fame, some of the Saint Fame teams started Zora, and there's actually another team as well that came out public a week or two ago with Foundation that also does the same thing. Bonding curves, limited edition goods, and the way it works is you as a fan, can buy a limited edition good. And as we know, this has become a popular thing in culture, the hype culture. You buy like a limited edition sneaker or a limited edition jacket or jersey. And it's automating that process, right? So you as a fan can go, I want this limited edition good. You buy this token from this bonding curve that you can then exchange for the physical good. But while you have this token, you can trade it on this bonding curve. So it's like, I think this is going to be the best new shoe that's going to come out. Buy it at $100. 2 weeks from now, the price is $400. You're like, do I still want this shoe or not?
But to be clear here, the reason why the price is $400 is not because of like some type of perceived value. It's because ideally in those 2 weeks, all of the people bought from 100 to 400, right? Yeah. So just to be clear, so like the way that, I think that the way that Saint Fame works is like there was like 100, let's just call it 100 limited edition shirts. They're all tokens, and you throw your Ether in and you get a Saint Fame token back, and you can redeem that token for a t-shirt if you want, but you don't have to. But then, the first token is like $8. The next token is like, $12. The next token is, $15, and all the way up to, I believe it's like nearly infinity. So you can never buy the last one. That's just that.
You can't,
right?
Yeah.
And if I'm not mistaken, then, so if you're like the second or third person, you're paying like $20 for the t-shirt. And if it's really popular, then everybody else is paying, a higher and higher kind of price. And then if I want to, I can, take profit basically. And how does it work then? What do I do, and what happens with my token? Let's say that I'm happy with like the price is at like 400 and I bought it at like 20.
Yeah. So what happens then is that, if you bought it at 20, you have this token that only represents the limited edition good. And then you can choose, I want to redeem it, and then you get the limited edition good, or you can just sell it back into the market. So at $400, you can sell it, you get your $400, or like.
But who's paying me the $400?
So that's where the bonding curves come in. When people pay for this limited edition good, the money goes into this pool, right?
All of it?
And then, so that's kind of where I think Zora and Foundation are trying to experiment with different ways in which the creator gets the money. In Zora's case, it's if you exchange it for the limited edition good, the creator gets back the token, and then they can choose to sell it in to get the money, out. But you as an individual, while you still have the token, you can do that as well. So the money comes out of this reserve or this pool where everyone puts the money in, and that's where the liquidity is. And
but then what is the issue? So if the money,
So that's like the issue, or in Zora's case, ideally it's such that, either most of it sells out and they can just sell all the, like if all the tokens have been exchanged for limited edition goods, they can go back in and just take the money out that's rightfully theirs. It's still in the pool, right? But the sort of more difficult thing about that kind of design is that, like, you as the issuer need to decide when you want to sell your own limited edition token that you just exchange for like a shoe or like a shirt. Whereas I think Foundation is trying to make it a bit more simpler. They also they're designing just the bonding curve differently, because like bonding curves can also have different outcomes. Like the ones that Zora uses Uniswap as its base, which means that, like you said, the final item will cost infinity essentially. Like it's impossible to buy. But Foundation is just saying it's like a linear curve. It doesn't go up exponentially, and someone can actually buy the last product.
So what's the benefit? Oh, sorry, go ahead.
Yeah, and I think the Foundation team also said, like, once as people are trading this product, some fees also go to the issuer or creator. So it's like the creator gets money from the activity that was generated, but also money from the goods that was sold. But that's still, I think, what people need to figure out. Like Zora and Foundation team is like, when do the issuer get money? When does the issuer get money? You know, is it when people buy? Do they immediately get a chunk of money? In that case, it would be something like more similar to Fairment, where it's just like, let's just give some money straight up front for every one that's sold, just give it straight to the creator. Or is it like when all of it's sold out, do they then get access to the whole pool of money that's in there? Is it about this activity that generates money? Like, when should the issuer or creator get money? I think that's still something that people are figuring out. But on principle, it's like, I think people get it. And that's nice to see. And in Foundation's case, they're just hiding everything. You know, they're just saying, like, you go into the website, you see the current price. You know, if you buy it, the price goes up. And that's all that people need to know. There's some fancy math and algorithms in the background changing the prices. Yeah.
Yeah, I mean, I think that's, you know, coming from my background as a former art dealer and kind of former Sotheby's guy, the idea, and, you know, like I collect art, and the way that the art world works, and I think this is particularly revolutionary for how the art world could potentially work in the future, is that if you're an artist, you basically make a work, and then, you know, ideally you have like a gallery that's representing you. And if the gallery sells the work, then you get 50%, the gallery gets 50%, everybody's happy. And then if that collector who bought that wants to sell it again, they give it to the auction house. The auction house, you know, gets a cut, and the seller, the collector, gets the rest of it. The gallery and the auction and the artist get nothing. Generally, there is something called droit de suite. There's artist resale, right? Which, you know, sometimes legally there is, but it doesn't really work that well. So I like this idea that if I'm an artist and I basically create an artwork, and to make it easy, let's just say it's an edition so that there can be a bonding curve. Yeah. Then, you know, I as an artist, like, maybe I'm not getting 50% of, you know, the kind of median value of the actual work, but I'm getting something. I can get, you know, a little bit upfront, and it becomes more like some type of, you know, subsidy or annuity or something like that. I'm getting a little bit of like consistent cash, which, you know, really helps, because even though it's small, it's less risky. I can survive, you know, on, you know, and if it goes up, it goes up and I get more, but at least I'm getting something. And also it's not so expensive. And I like this kind of like alignments of kind of the buyer and the creator and even the marketplace itself, in this case, the gallery or the auction. So I think it's particularly interesting for that. One of our portfolio companies is called Forte, and they're a gaming company, and they're applying bonding curves to this type of thing, but for virtual in-game goods, which I think is quite interesting as well.
Yeah. Yeah.
So that's,
I think in-game goods, it works. It's a very smart idea. I think it works really well.
Yeah, I think that the thing that people get stuck on with physical goods is, how do you bind the physical to the virtual? So if I buy the sneaker, if I buy the token for the sneaker, how do I sell it back? I mean, in this case, like, I guess it's harder to sell a sneaker back, right? But what happens? Does the token get burned if I redeem the sneaker?
I think that also depends on the specific application. Like, it's because like Zora uses Uniswap as its base, but it functions similarly to a bonding curve, which is that once you sell, it's just the price goes down, right? That's the more important part. It's that it's like the price goes down, thus enabling someone else to come in and buy it at their preferred price or not. Right. But in the case of something like selling a sneaker, it's like it's like a pre-economy to this thing actually being physically available, you know. So it's just like, It's like you're trading a coupon before you actually get the item. Yeah.
Okay, I think that's pretty easy to understand. All right, so let's talk for like maybe like 3 or 4 minutes, and then we'll open it up for questions. So we have kind of St. Fame, there's Zora, there's Foundation. What about security tokens and digital assets? I mean, you kind of touched on the Fairmont model. We invest in security tokens, and we're big believers in the whole kind of digital asset infrastructure. How do you think that it works for fundraising and crowdfunding, and how do you think it's a good model for kind of continuous price discovery and of shares and this type of thing? How does it fit into the whole security?
Yeah, I think, obviously like the most difficult part of bonding curves in like the security space is that it's a very new, it's like new ideas that still have to be battle tested in terms of the legal space. Like, it's like, how do we figure out how this works completely? And Fairmont just said, it's a security. We're not going to try to pretend it's something else. It's security. But
so
I think
only open is it only open to like professional investors then? Oh, so that's quite limiting then. It's not good for kind of retail mom and pop.
Yeah, but like the DX DAO, it's open to anyone. So it's like I'm not sure what the legal sort of diligence is necessary there, but like they allow that, right? I think the value in just merely in terms of fundraising is that I think there's still a kind of trade-off to continuous fundraising that is not necessarily good or bad, because as we know that sometimes public markets trade more on a shorter term rather than longer term perspective, right? So sometimes you don't want to, you're building a company, it's like in its early stages, it's very volatile. You don't necessarily want to saddle the company with additional responsibility or like fears or concerns about like the price fluctuating like this the whole time, right? Like your employees come into work, or you as a founder come into work and go like, guys, the price dropped by 50% today. That's tough. Like it makes things tougher to be on demand to the market with a continuous fundraising system. But I think ultimately the value, I think, especially for many companies across the world, is that you just have access to more capital and more liquidity through these continuous fundraising systems. It's like more people can invest in companies in an easier manner from anywhere in the world, provided it's obviously proper legal diligence has been done. And your company has access to liquidity, and you as an investor have access to liquidity. So it creates this possibility for much larger long tail of investments, where you can go like, I think that's a great idea, but I don't have to be committed to wait like 5 or 6 years for this to be listed on a public exchange somewhere, right? I can sit for 2 years and go, this was great, I'll get my money out. No worries about it. So I think that's like the biggest factor that could produce like a lot of value. It's just the fact that there's more easier access to liquidity.
Is there what's the downside of bonding curves? Like is there such thing as like a ceiling to the signal? So let's say that the price doesn't go to infinity, it just goes to like 1,000, and then you're sold out, right? So the price goes to 1,000, someone buys 1,000th one, and then there's no way to kind of signal that can it ever be worth more than 1,000? I mean, is there such thing as like a secondary market in the context of the bonding curve? Like, how does it expand beyond the model?
Yeah, I think that's also like, it's not supposed to be like a holy grail market exchange mechanism. It is, for me, so it's primarily a way to do price discovery in the absence of additional secondary markets, right? So, it's like, what should we price this thing at? Well, we don't have to worry. There is an automated algorithm that prices it, but it's not necessarily the best way to price a specific asset, but it's good enough. It's that there's something available that's good enough, right? We don't have to find an exchange to make an order book or something. It's just there's liquidity, it's available, and it's good enough. But like once markets get very big with say bonding curves, like there's a lot of liquidity and certain things, then you're still beholden to the specific algorithm that makes up the price discovery. And that can be good and bad. Like the fact that there's always like a price discovery of last resort, that's good. But sometimes it's like people might value it differently. But that's not necessarily a bad thing. If people want to move away from the bonding curve, you can always have access to secondary markets. You can buy the token in the bonding curve, but then exchange it in Uniswap or some other kind of centralized exchange. And that's what people are doing in, say, the case of the DXDAO, or even with Luxora and Fairmint and others. Like that, it's like there's an initial minting process that's through this bonding curve, the initial like price discovery of last resort, but there's always this ability to trade in on secondary markets where there might be more liquidity, like an order book or a full order book, for example.
So if I kind of take it away, the bonding curves are really like, you know, the kind of the training wheels for a market, just to kind of get it going, and then market forces can do whatever market force can do, and if for some reason the market breaks down, you still have your training wheels, which will kind of keep you upright down to basically the last token.
Yeah, I think that's a good way to put it. Like it's like it gives the people that want information about the market pricing the ability to see that, oh, there's at least this kind of liquidity available forever and always. Like you can't get, but liquidity won't disappear. It will only disappear when people trade it away.
Interesting. Yeah. Cool. That's super fascinating. Any last words on these subjects before we kind of like open it up to kind of questions and just kind of have a chat with everyone? Things that you want to see, or things that you know, you hope people will build?
I think you know, it's like my initial into the space and why I got excited about tokens and why I got excited about token bonding curves have always been like using this technology to empower communities. And I think especially, you know, with what we've seen this year happen across the globe in different capacities, it's like I still want to see the ability for people to create wealth amongst themselves, you know, without relying on other systems around them, you know. And the simplest forms have always just been, let's do this for curating information, because that's what communities might care about. So that's still something I want to see exist in some capacity, on like a proper scale, not sort of playing around, but time will tell whether that's still a good idea or not, or whether it was just wishful thinking or not. But otherwise, I'm pretty happy to see it getting into like more the cultural space. Even with things like the RSC doing it in music, this like physical tape you can buy and sell. That was pretty cool to see. Yeah, I think there's still a lot to do. I think also as well, I'm pretty excited about sort of the more deeper academic side of the way people have been looking at this, and it's gone over my head. I think I thrive in taking things from 0 to 1, and then other people take it from 1 to 1,000 and like write these incredibly beautiful papers with a lot of math and beautiful equations that I don't understand, but it's awesome to see. And actually tomorrow there's like a token engineering meetup also online that goes into much more technical detail with a lot more academic approach to bonding curves. So I recommend checking that out.
Awesome. Okay, cool. Well, thank you. Here's my kind of virtual clapping from the community. Well done. Why don't we just kind of open it up? I mean, I don't have everybody muted. I think everybody's kind enough to kind of mute themselves, but there's not so many people here. I think we can have a relatively civil kind of questions. If anybody wants to ask Simon questions about some of his projects or work, you know, unmute yourself. Do me a favor, introduce yourself, and then ask away.
Hi, Simon. Hi, Jehan. Nice to meet you. It's actually a pleasure. We've been reading your papers since you published them, and it's quite an honor. Listen, I'm Jonathan. I am the CEO. I have a couple of colleagues here. I'm the CEO for the Latin American office of a blockchain AI consulting company. And we're trying to help, you know, companies democratize, decentralize, digitize, etc. we've been following the Fermin model. My questions are going to be directed specifically to the Fermin model, because we've started way back in, we have colleagues in Malta. We started way back in 2019 at the Malta Summit with a client with which we traveled, and they're in the real estate crowdfunding business, right? And real estate is really important in Latin America for the community because it's one of the safe havens we have for all the crazy fluctuations, and that's also a reason for DAI being so successful here. And so this client in particular has as their community people that prior to them did not have a way to access the real estate market. And so what they do is they replicate the real estate market. And so we always talk about this 70% of the population that either have their cash in the mattress or outside the banks because they don't trust it. Okay. And they have a few $1,000. And we started thinking about doing the DAT, which then is called CSO, CO, whatever. But we started thinking about doing the DAT model, and we've seen some maybe, I don't want to deem it as oversimplifications, but there's been heavy simplification of the Fermin model from what we saw in the papers. So that's the first question. What do you think about their model right now? Because the smart contract only has like 4 equations, and they assume all the others remain constant. The second question is, what about a progression in the slope of the curves? And the third question is the role of the company. I'm sorry for making these 3 questions. They're really important for us to gain your opinion.
Go ahead.
And the third question is the role of the company participating in buying the tokens or the shares or whatever it is back from the market, or even from real investors as an exit for the for the first investors before it's open to the community. Thank you very much.
Thanks, Jonathan.
Awesome. So the first question about like Fermin's model, I think I've spoken to a lot of people in the space that have thought about bonding curves and asking the question like, how should we design this curve for specific outcomes? And I think a lot of people have realized like we don't actually know. We don't actually know what's the best one to do. And so in some capacity, it's just like, let's make it as simple as possible to start with and just see how the economy responds. And that's why even things like the block science team with CAD and things like this are going towards like modeling different agents involved with a curve and just seeing how people would respond. My personal opinion is I think that's good enough. Like I think it's good enough to start and just see how it works. Building sort of progression into it, I think that's difficult about adding kind of like a progression into curve. Let's say you want an S curve, right? Is that you have to know beforehand exactly where that should be in your thing. Otherwise, you might damage the economy if you do it incorrectly, and that's difficult to do. And that's why I would probably still recommend people just to start simple as possible, because I think in many capacities, like it being good enough is fine. And you don't want to do anything fancy, because if you do anything fancy, it might destroy the value that's being produced there. And the third question was around sort of the ability for the company, like how does the company fit into the model, and like whether people can buy back or not. That's a brilliant idea. I mean, it's like, instead of that's just another way to use this, right? The company can buy back this thing or like invest itself into this trust or reserve on the side. And that's also definitely possible and another way to do it. And I think just time will tell. Like time will tell what turns out to be good in what circumstances. And it turns maybe it be like in a context of like a company with like regular revenue, right? It might look different to say a real estate company with like less frequent liquidity events. So maybe not the most satisfactory answers, but like it's time will tell. And like that's why we are here today. Like we need people like you guys too that are asking these questions and figuring things out.
Thanks, Simon.
Thank you very much.
Other questions? Thoughts or commentary?
You said something interesting about the security token space, and what you described there with property prices and stuff. Like, it seems to me that once you get to a certain, price per unit, let's say it's a house and it's earning, X amount of rent, it just makes no sense to pay the $400 per sneaker or per brick or whatever you want. Like, it has a certain revenue generating potential. So the curve wouldn't be linear or exponential. It'd be like logarithmic or something. You would get to the certain unit price. And if people want to buy more units in the venture, they just buy more apartments and whatnot. So I think it would be a different curve for those sort of things. You would have to build it differently.
Yeah.
One of the things that
I'm a fan of logarithmic. Yeah.
Oh, sorry. Go ahead.
Sorry. Yeah. No, I'm a fan of like logarithmic curves, mostly because like for certain contexts, it incentivizes people to move on. So like the speculative, if a community is properly funded, there's like less speculators around, and so if you want speculators in the beginning to provide capital, but like once it's fully functioning, it's like, thank you for helping us bring this thing up to speed, but you won't benefit so much anymore. I like that dynamic.
And then once you hit that logarithmic point, it becomes that buyer of last resort, because it's always going to be $200 a brick. And if you want to issue more bricks, you just hit the curve. And on Uniswap, it goes through the moon, then they could buy it and sell it back.
One of the questions I had was kind of actually what I had originally pinged you about. Is there a way, I guess it's two questions. One is there a way to have like a bonding curve of one for you? Like, how do you think about bonding curves for unique items? Because again, I'm going back to the art world where, every item is unique, and most bonding curves like assume that, the items inside are fungible. And then the second one is, and it's related, is there a way to have a bonding curve of multiple non-fungible items? Or does one answer the other?
Yeah, I'm glad you asked that, because that was the original call we wanted to have. So yes, I believe so, and I actually designed one such example. And I wrote an article about it, but like the original question I tried to answer was, you see all these collectible economies coming out, right? They, let's take CryptoKitties, for example. And you ask the question, how many CryptoKitties should there be, right? Or like CryptoPunks. CryptoPunks did 10,000 CryptoPunks. Like, how do you decide? Should there be 100? Should be 10,000? If you go to the extremes, right? If you say there should be 10, you might not be capturing the potential value of this economy that you want to create. Like, it's too few, like it's too scarce, right? If you create 10 billion, it's just too much. So the economy doesn't work either. So on two opposite ends of the scale, too little, people won't care enough about this, or you might not be capturing the most of the value. And if it's too much, no one might bother, because it kind of loses its material value as a collector's item. So the question was like, how do we make it such that there's an optimal amount of collectibles in a specific category? And in this case, it's a category of like CryptoPunks or CryptoKitties, where you have separate non-fungible items that share a characteristic or belong to a set, right? So like all the CryptoPunks or all the CryptoKitties. And the way I designed it is that it also works with a bonding curve, right? Surprise, surprise. And in this way, it's like when you choose, there's some supply of collectibles that is available, but it's not circulating in the economy. If someone wants one of these artworks from this available supply, they can buy it on this bonding curve, and then it becomes available to circulate in this economy. Someone buys a new CryptoKitty. And then if someone doesn't want this CryptoKitty anymore, they can either sell it to someone else as a non-fungible item, or destroy it and take liquidity out of the economy again. So in that sense, CryptoKitties would grow if there's more interest in CryptoKitties as an economy, and then it would shrink if people don't want CryptoKitties anymore in the economy. So the optimal supply of this collectible in this category would grow and shrink based on demand for it. But there's one difference here that makes it different to fungible bonding curves versus a non-fungible bonding curve, which is that different non-fungible items would have different values, right? Based on whether people like it or not, right? So, different CryptoKitties have different values. So what this bonding curve essentially does, it just creates a floor to the value of each item that's currently circulating. So at any point, like if you bought a CryptoKitty for $10 and there's 100 in circulation, and now a CryptoKitty costs $200 and there's 10,000 in circulation, anyone at that point can sell any CryptoKitty for that specific price at that high point. So there's always a floor of value for all the current circulating non-fungible items in this category. And because it might be valuable to different people, once you sell it or want to sell it and take it out of the economy, it just goes into this auction period where someone can say, hey, don't destroy that. That is actually a really cool CryptoKitty. I actually wanted it. Just wait up, stays in the auction period. If no one wants it, the person that sold it gets their money out. Otherwise, it goes to someone else. So that's like a basic design, and I hope it's well described enough, because it's difficult to maybe like get it in one's head. Yeah.
No, because the CryptoKitties already have this Dutch auction mechanism anyway. But as the price goes down from like 100 ETH to 1 ETH, instead of it just like the auction ending, it gets bought by the buyer of last resort, which is the bonding curve.
Mm.
So you can still fish for 100. Someone snaps it up at 50. At the end of the auction, no one wants it. The bonding curve swallows it, cannibalizes it.
Exactly. Yeah.
Gives you back your 1 ETH.
Yeah. But I think the cool value of that is that all the current collectibles that would be circulating in this category would be things that people really want to have, right? Because otherwise they would just get rid of it, sell it, burn it, destroy it, and get back some liquidity. And so that also brings new people into it, because if you get to CryptoKitties now and you see there's like 100,000 of them, you're like, this is so many, like which ones do I actually want? But if the things that are only available that's circulating that people really want, it's more visceral. Like these are the things that people really care about at this stage of the economy.
Interesting. There's another question from Nelson. Beyond CAD, it seems that blockchain games with scarce economic systems would be great to test assumptions, behaviors, innovations here. Are you aware of anything interesting in this space?
CAD-CAD's the one that comes to mind that is probably the most advanced and has a lot of people working on it. Sorry?
What's CAD for those who don't know?
Yeah. So CAD stands for Complex Adaptive Design, Computer-Aided Design. Now, complex adaptive, something like that. But it's like essentially the principle of AutoCAD, which is like the design of systems engineering principles towards token economics. So, you can simulate these systems with different incentives, different stressors, and things doing different things at some time, and like get a certain outcome from it. Yeah, that's pretty much the only one I think that is, I would say, like, if you want to model an economy, that's probably the best place to start for sure. And check out the token engineering community in general. Like there's a wiki out there with a lot of information as well.
Yeah, I would throw in, again, I kind of mentioned before, but Forte, which is probably I think maybe one of the larger kind of players doing this. They have a number of game publishers on their platform, like relatively larger ones. This is the company that has like a $100 million kind of grant fund from Ripple to basically push, their system. So they're applying bonding curves to NFTs and in-game items and basically helping game publishers figure out how to use NFTs and change these kind of continuous sales models. Because like, I think it's pretty interesting the way they're doing it, because they really are trying to alter the way that game economies work.
Yeah.
Typically, it's kind of like fashion. It's like seasonal. Like every season, they'll print more new items, and you go for them. But there's no floor to the value. And the way that Forte works is each of the virtual items actually has, not only is it on a bonding curve, but it actually is collateralized by another crypto like BTC or a stablecoin or USDT or something like that. Or like, so that's pretty interesting.
I love that. I think there's another team as well. I forgot the name now, but it's Kathleen Brightman from Tezos. They have this company, which is it them? No, it's not them. It's like, I think they're something else, but they're doing this for trading card games. And I think it makes so much sense in a trading card game context, because it's like, I remember playing trading card games and like everyone knew like, oh wow, like this dragon is very rare and like powerful, people want it. So there's this economy in trading card games. But in this case, it's like, if you want a specific card to put in your deck, you just buy it and mint it from the bonding curve, right? Which immediately the price goes up. And if this is not the current meta in the game, this is not useful anymore, just sell it back and then get back money to buy different cards in the game. It works really, really well. Just makes so much sense.
It's called
it also rewards the players, because if you're a player and you invent a new meta that uses specific cards in this world and makes them useful, other players are going to buy that card to put in their own decks, right? And then you make money, right? So it's like, if you constantly innovate in the meta of the game, like, you will make money. That's really cool. I love that.
I just threw in the thing. So cool. Well, I think if there are no more kind of urgent questions, we'll wrap it up here, so people can gracefully log off if they like. I'm going to be hanging out for a few more minutes, just kind of chilling with Simon. But everybody is welcome to just kind of hang out and enjoy your drink if you have one, or your coffee if you have that instead. But thanks everybody for coming. Really appreciate it. And thank you, Simon, again for kind of doing this. It's always kind of a pleasure to talk to you and kind of learn from you. So really appreciate it. And we'll be doing another Ethereum meetup, virtual meetup soon. I've got a couple speakers in mind. We might go the enterprise route next time, so stay tuned. And it's great to see people from so many different countries. So again, thanks for taking time to kind of come out and log on. Thanks.
Thank you so much. Bye-bye.
Thanks, Deborah. I wonder how many different countries are represented here. Adrian, where are you located?
I live in Thailand, but I'm Australian.
Oh, okay, cool.
I live in Canada, but I'm French. So you have a bit of everywhere, I guess.
Cool. Well, you're up early. Thanks for making it.
Yeah.
And
super. If I have just 1 second to ask a question to Simon. Simon, what do you think about the current advancement in Ethereum 2.0?
So personally, I've been involved in Ethereum from day one. Like, I started coding before there was a network, and I've been following it since then. And like, because it's been changing so much over the past 5-6 years, it's like, I haven't done my sufficient due diligence to keep up to date with the technical state of Ethereum 2.0. Like, only now, like literally where I went like, okay, there's clients I can run now, and it seems like the spec won't change for the first phase. I'm going to dive in and see how this works and what's going to happen. But for the most part, this has been ongoing for five years, and most of the activity has come in the last year or two. So it's exciting for sure.
Cool. Thank you.
Yeah. I think it's like for me, it's like, I think the last time I like ran a node on my own computer was like 5 years ago. And I'm actually really excited again, just to do like the lowest level technical nitty gritty, run a node on my computer and like maybe stake some ETH and participate in Ethereum 2.0. It really feels exciting again. You know, it's like a next stage evolution of this, and it feels a bit like the earlier days in some sense, but it's Ethereum 2.0, so it's exciting.
Cyprian, I'm curious, what do you think of ETH 2.0?
I think that there are like super good advancements. The issue is that you have a lot of parallels advancement at the same time. So the whole strategy of Ethereum is not decided as, I mean, it's a community focused advancement. So you don't have one main guide of like the main roadmap. You have a lot of developers working on different stuff at the same time. And so I think as a whole, we are all waiting to see like what is, how the sharding is going to come up, because that's one of the main feature of Ethereum 2.0. And you have like a lot of different issues right now with Ethereum. And I think this is a super good thing. Like if you see what Vitalik shared, I think it was like a month ago, he shared like a super high level view of what is the roadmap of Ethereum in the next, I don't know, like 3, 4, 5 years. And you have super cool stuff happening. Like they want to implement like post-quantum cryptographics. There's like a lot of really deep and important and necessary technical advancements. And this is a good direction. And I think like a lot of other like sidechains or other like kind of altcoins are going to have a lot of problems, because if Ethereum is actually delivering and is actually complying with like all the huge promises and huge goals that they have, it could become like a very standard blockchain for everyone to use. And when you look at the level 2 now, the layer 2 that they are implementing, I mean, this is going to be the base for a lot of companies. I'm right now launching a huge, I mean, it's a huge project I've been working on for like the last 3 years, and I'm exploring like a lot of different blockchains frameworks. And now I'm like, if Ethereum actually does comply with the main vision, I have no other option than to take Ethereum, just because of the sheer size of it, the sheer number of people contributing to it, and the actual goal, like long-term goals. Like you don't see that many blockchain project with like such a very deep vision of what it should be and how it should work for the future.
Well, just out of curiosity, which publication or which article or video was it that you're referring to from Vitalik?
It was a tweet that he made like a month ago, and it's like it's super cool. It's a diagram, and you see like where is the Ethereum 1.0 and 1.x, because now we're like it depends like what version you're looking at, and then it's just you have all the different branches with all the different like so you have the token economics, you have like the security part, you have the cryptographics part, you have like every little level of possible development is kind of studied, and then you have all the different branch outs that are going to be like very long-term future goals. And so you have like all the sharding part is very important, because this is one of the main issues that people were a bit scary about Ethereum scaling up in the future, and like now it's something which is an ongoing work in progress. So I'll try to actually find that tweet.
Find it, throw it into the chat. That'd be helpful for people. Super interesting.
Sure. Yeah.
I think what's also meaningful as well still for me about Ethereum is that, you know, it's like after I left Consensys, I basically did one project. This artwork is always on sale, and then I didn't code for a year. You know, I still looked at everything and looked at all the code and what's being done, but I didn't code for a year. And now I came back to coding and using Ethereum and just trying new frameworks. Like I just let me try rebuild this code in like completely different frameworks than what I was used to, and just see what it's like. And it was great. It was great because like the documentation is good. That there's people you can ask for support. Like people are actively developing, and that's nice. Like it's just great that there's active development and active documentation available. You know, things just kind of work, right? Much more than it did in the past.
And also, the really cool stuff is that you have a huge community of token engineers that is beginning to form. By the way, just super small ad, just join the community of token engineering. Just look for us on Twitter. So at token engineering. And we also have a Discord group.
What is it?
So basically, the goal of the community is to construct the basis of what is going to be, what is a token engineer? Like what is engineering a token mean? And how do you build token in a way that are respectful for different levels of regulatory things, economic things, cryptographic things, and like all the different ways that you can actually engineer this new model of economies, but also new models of organizations, new models of collaboration between people. And it's the foundation of that is really like the understanding that as people who are actually building out these models, we have a responsibility, we have a kind of a fiduciary duty with other people. So someone who is going to build a bridge has that duty towards the greater good of the commons, basically, and be like, if I build that bridge, I kind of assure you that it's not going to collapse. Then if I'm building a token for the whole community to use, I need to have trust in this token, and I need to have trust in the people building it. And so the goal of the token engineering community is to foster that idea that not everyone can build tokens. You have to actually like study it. You have to build it, try to find the right way to do it, and have that greater good idea behind it, that you are not going to try to defraud everyone. You are just trying to build something that is going to have a lot of value for the community. And so this is the goal of this. Really, like we're just starting out like for the last year or two, and I think this is really interesting because that's referring what Simon was saying about like. You had that huge explosion before of a lot of different projects doing a lot of stuff. You have all the ICOs, like a lot of tinkering. Everyone was just trying out some stuff, and you had like all the shitcoin things. And now I think we are in the period where people are kind of trying to find a way to build stuff that lasts and that makes sense, and that bring value to everyone. And so you have kind of a step back where we're not seeing like thousands of projects. We are seeing like some projects that are very focusing on a niche market or on a very precise application of the DLT. And then you have the academic background that is starting to come forward also, where you are, okay, like what is a bonding curve? Like how do you define the rates of growth of your bonding curve based on different economics, like the economical story that you want to tell to your community? What is exactly like the rate of progression that you want to implement? If you want to build like dynamic bonding curve, that is something I'm researching on right now, like bonding curve that varies based on a different set of factors. There is no research on that. And as Simon said before, there is no currently a lot of experiments that are successful enough and that has enough scaling so that we are able to draw conclusions from that. And so I guess,
like, which university comes up with the first degree in token engineering?
Yeah, that's interesting. Like, we don't know.
I never heard the word of like, I'd never kind of thought of like it as a career, like a token engineer, but it makes like complete sense. And it is very unique. Like you got to know about a bunch of different stuff. It's like it's more than just a financial engineer because it's also a technical aspect.
Oh yeah.
Like a signal.
So you have complex systems in it a lot. So you need to understand like what is complexity, like how does it work. So you have a lot of economical and financial, of course. Then you have the technical aspects. Then you have the governance, which is like incredibly hard. This is like the last layer of of where we are heading to. I think the technical part is kind of understood, and now we are moving to the economical part, which is actually very hard. Then you have the community engagement, which is pretty difficult because you're dealing with humans. And then in the end, you have the governance part, which is, yeah, incredibly hard. And we still haven't found a way to make it work. And this is why actually this new field, I guess, of research, which is the token engineering, is hitting to like, how do we build a sustainable value allocating organizations that are able to actually provide that value redistribution to the maximum of people that are involved into it.
Cool. Throw the link of that group again that you're in into the chat so people know. Someone already found the link to the.
Yeah. I saw Paul found it. I found it. Thank you.
So if no more last questions or comments, I think we're gonna wrap it here because I need to eat dinner. Selfishly. But again, thanks everybody for kind of showing up and for listening. Really appreciate Simon taking time out once again from sunny South Africa. And yeah, great to see everybody, meet some new faces. There's Cyprian's twitter.com's tokenengineering, one word.
Yeah, I don't know why they put it that way, but yes.
And Simon, what's the best way to contact you? Twitter or?
Twitter, yeah.
Awesome. All right. Well, thanks everybody for coming. See you next time. Have a good night. Thanks, Simon.
Thank you very much. Cheers.
Bye.
Thank you, everyone. Thank you, Simon. Thank you, Jehan.